Credit scores play a vital role in the financial lives of millions here in the UK. You see, they can determine your eligibility for loans, mortgages, credit cards, or even a phone contract. However, credit scores are often misunderstood despite their importance, leading to widespread myths and misconceptions. So with that said, in this video, I will debunk 13 common myths about credit scores here in the UK, helping you to understand how they work and how to maintain a healthy credit score here in the UK. Now, the first myth is that checking your credit score would harm your credit rating. In reality, this is not true. When you check your credit score, it is considered as a soft query, which does not impact your credit score. Only hard queries made by lenders when you apply for credit can potentially lower your credit score. And it can even lower your credit score if you're taking back-to-back loans. So if a hard query is done multiple times within a very short period of time, it can impact your credit score negatively. Now, regularly checking your credit score is actually a good habit, as it would allow you to monitor your financial health and areas where you can improve your credit score. Because when you go on all these credit reference agencies websites like Equifax and TransUnion. Now, if you go on their websites to check your credit score or your credit report, they would actually give you tailored information on how you can improve your credit score based on your financial situation, or based on the information they have provided, or based on the information they have about your financial history in the UK. So it's always a good thing to check your credit score from time to time, or your credit report from time to time, and so that if there are any errors, you can correct it. Now, the second myth is that registering on the electoral roll here in the UK does not impact your credit score. Now, in reality, registering to vote here in the UK, or you being on the electoral roll here in the UK, is actually a significant factor that can impact your credit score positively. You see, here in the UK, lenders would usually use the electoral roll to verify your identity and address history, which can improve your credit score. So if you are not registered on the electoral roll here in the UK, you might actually find it hard to build your credit score or to get a credit here in the UK, because they can easily prove your information and address history. Now, the third myth is that the amount of money you earn, that's your salary, is directly tied to your credit score. Now, in reality, your income does not directly impact your credit score. Credit scoring models here in the UK focuses on how you manage credit, not how much you earn. However, when it comes to taking out a line of credit, your income might actually affect how much credit lenders are willing to offer you based on what they perceive would be your affordability to repay the loan or the credits. Now, myth number 4 is getting married to someone with a poor credit history will lower your credit score. Now, in reality, your credit score is an individual thing, like it's a personal thing. Marriage does not merge your credit histories together, so it will technically not affect your credit score. However, if you apply for a joint credit, like you take out a mortgage together, their credit history could impact the terms of your mortgage, like the terms you are offered for your mortgage. But it doesn't change your personal credit score. I don't know if that makes sense. Again, if you guys open a joint account, so let's say you marry someone who has a terrible credit score and a terrible financial habits, and you guys have a joint account, right? However that person manages the joint account would reflect on you, because you guys took the account together. Or if you guys take out a credit card together, however that person you got married to manages the credit card would impact you, because your name is on that financial document. I don't know if you get what I mean. So choose your partner wisely. Choose the people you want to associate yourself with financially wisely, because if you take out a loan with someone, or you have an account with someone, a joint account with someone, that person's financial behavior on that particular loan or account would actually impact your credit score. So be wise. Now, if you have watched this video to this point, it means you find this video valuable. So please like this video and share this video with someone you think will find it helpful. Now, moving on, the fifth myth is that closing old or unused credit accounts will boost your credit score. In reality, closing old accounts can actually harm your credit score because credit scoring models consider the length of your credit history. So older accounts actually help demonstrate a more extended history of responsible credit use. If you have a responsible credit history, if you don't have a responsible credit history, it will actually demonstrate that you do not have a responsible credit history. So basically, closing old accounts would reduce your credit history, like it will reduce your available credit, which can reduce your credit utilization ratio, a factor that can lower your credit score. Now, the sixth myth is that once you pay off your debt, if you have any loan or any debt, basically, it immediately reduces your credit score or shortens your credit report or history. Now, paying off a debt does not remove the account from your credit report or shorten your credit or reduce your credit score, because the account will be marked as paid or settled, but it will still stay on your report for up to 6 years from the date it was closed. So basically what I'm trying to say is that paying off a debt will not shorten your credit history or your credit report or lower your credit score. However, paying off the debts can actually impact your credit score positively or negatively depending on how the debt was managed when it was taken out. So let's say when you took out the debt, you did not pay your monthly repayments on time or in full. Obviously, that will negatively impact your credit score, but if you did manage that loan well, it will positively impact your credit score even if it is closed. So whether it's closed or opened, as long as it is well managed, it will impact your credit score positively. But if it wasn't well managed, it will impact your credit score negatively, even if it's closed or opened. Now, the next myth is that everyone has a single universal credit score. In reality, everyone does not have that, because you do not just have one credit score. Like in the UK, we have like 3 leading credit reference agencies. That is Expedian, Equifax, and TransUnion. Now, each of these credit reference agencies have their own scoring system. So this automatically means that you could have different scores depending on which agency's data a lender checks. So if they check TransUnion, your credit score will be different from what Equifax will show them. So it just depends, and everyone cannot have like a universal credit score. Everyone's credit score cannot be the same because we all have a very different relationship with money, and we all have very different financial habits. Now, myth number 8 is applying for multiple loans or credit cards in a short period of time increases your chances of approval. Now, in reality, multiple applications for loans or credit cards within a short period of time can actually harm your credit score and reduce your chances of being approved for a credit card or loan. You see, each loan application or credit application actually triggers a hard query, and severally in a quick session can suggest to lenders that you are in a financial difficulty or desperate for credit, both of which can lower your credit score and reduce your chances of even you being approved for a line of credit here in the UK. Now, the next myth is that using a credit card will damage your credit score. Now, in reality, responsible credit card use improve your credit score. Regularly using your credit card and paying off the balance in full each month demonstrates to lenders that you can manage credit responsibly. However, if you chose not to be responsible with your credit card usage by maxing it out or missing your monthly payments or not paying your credit card in full, it will actually harm your credit score and it will destroy your finances basically, because now if you max out your credit card and you not pay it in full each month, you will start to pay interest on the money you owe on your credit card, which can be really messy. You know, it will just be snowballing because the money you did not pay in full would accumulate interest, and by the time the next month comes, if you do not pay the interest and the money you owe in full, another interest will come on it, and that's how you just snowball into debt. It's always advised that when you take out a credit card, whether it's for building a credit score or you need it as a backup plan for managing your finances, you pay your credit card in full and on time each month. Now, myth number 10 is that there are some financial services here in the UK that can legally and effectively boost your credit score if you pay a fee. Now, learn to do things by yourself. Not every time you want to pass corner or go through back door. Now, be wary of any company that claims that they can help you boost your credit score if you pay them money. Because while legitimate credit repair services can help you address inaccuracies on your credit report, there is no legal way to buy a better credit score. Like, you cannot purchase a better credit score. You can only pay a financial advisor to help you repair your credit history, or pay like credit repair services to help you look into your credit report and provide suggestions on how you can build a better credit score. But you can't pay to get a good credit score. You have to build it yourself, basically. Now, improving your credit score involves responsible credit use over time, not looking for shortcuts. It just has to do with responsible financial behaviors. Stop looking for shortcuts. Build your credit score yourself. If you want to know how to build your credit score, I have a video on how to build your credit score. Go and watch it and learn how to build your credit score, or go and pay a financial advisor to help you build your credit score. Now, the next myth is that late payments have an immediate and major impact on your credit score. This is true and this is not true. Hear me out. While late payments can negatively affect your credit score, the impact might not be more immediate and severe like you think. So basically, a payment that is just a few days late may not have been reported to the credit reference agencies here in the UK. However, 30 days or more overdue payments are likely to be reported and can significantly damage your credit score. So pay your bills on time and in full. Missing a payment does not mean that your credit score will be impacted immediately. You would actually be given a grace period of how to pay it and when to pay it. And if you now miss that deadline, maybe like 2 or 3 times, that's when they will now report you. So put that in mind. Now, myth number 12 is that your credit score is the sole factor that will determine your loan approval or the interest rate of your loan. Now, while your credit score is critical when it comes to applying for loans, it is not the only factor lenders would consider when determining whether to approve a loan or a credit card application for you. You see, lenders would also look at your income, employment status, existing debt, and how much you want to borrow. A high credit score can actually improve your chances, but it doesn't guarantee that they will approve you for the loan. They would look at your overall financial situation before they approve a loan for you. I've already mentioned some of it already, like your employment history and other things. Now, the final myth, perhaps the most damaging myth of all, is that your credit score is a reflection of your worth as a person. No. Your credit score is simply a number that reflects how you have previously managed credit. If you have previously managed credit badly in the past, it doesn't mean that in the future or now you will manage credit badly if you start to do the right thing, if you start to cultivate the right financial habits. It does not define your value or potential. If your credit score is lower than you would like, remember that it is possible to improve on it over time with responsible financial habits. You know, you watching this video is an indicator that you want to do better with your finances. So all you just need to do is to gather knowledge that can help you boost your credit score if you are looking to boost your credit score, or pay a financial advisor to help you look into your credit report and suggest ways on how you can build your credit score. And if you don't want to pay someone to help you do that, take time out, read books, watch a lot of videos, and find ways to help yourself. In conclusion, understanding how credits work is essential for managing your financial health. I really do hope that by debunking this myth, you can make more informed decisions about your credit and avoid potential pitfalls. Remember that monitoring your credit report regularly, paying your bills on time and in full, and maintaining a healthy credit utilization ratio would help you keep your credit score in good shape. Now, if you want to know how to build your credit score here in the UK as an immigrant without applying for a loan or credit card, watch the video on your screen right now.